Well, good afternoon, financial professionals. Dan Peterson here, President of E4 Insurance Services, welcoming you to the Brew, building relationships every week. I get to fill in today for Jennifer Nadeau, who normally does a great job leading our Brewcast and is actually at one of our carriers doing some continuing education and growth. And she'll be back next week to host the Brew. Thanks for tuning in today. If you're joining the Brew for the first time, we'd like to welcome you. And we like to start, as our tradition is, the Brewcast by celebrating today's National Day. Today is National Ohio Day. Now, I know we have some producers from Pennsylvania on the line, so they're probably not celebrating National Ohio Day, but it is National Ohio Day. It is National Deviled Egg Day. So what a delicious treat you can have with deviling those eggs. And National Stress Awareness Day. So if you're feeling stressed out, maybe have a deviled egg and take a trip to Ohio. But more importantly than our national days, we're celebrating this month Long-Term Care Awareness Month. And in looking at long-term care and long-term care awareness, we have a special speaker today, Shane Van Patten, who's a Regional Vice President for E4 Insurance Services. I had the privilege of bringing Shane into the insurance business right out of University of Mary, where he has a double major, and he played football, was quite the football player there. He joined, and I remember telling him, Shane, just come aboard, lend us your talents and abilities, and someday you'll be better off for having been with us and learn to grow and develop and have great opportunities. And Shane is really taking that to heart. Shane is a CLTC, certified in long-term care. He's served on the advisory board. He's currently an instructor, and he has for CLTC, and he has actually developed a 4-hour CLTC short course, if you will, for financial advisors. But before we start with that, I wanted, and we get into Shane's portion of the presentation, Shane, I'd like you to take a minute, because you're one of the most passionate people I know when it comes to helping advisors make long-term care part of their overall planning process. Where did that passion come from?
Sure. Thank you, Dan. Great introduction. The passion. I've been in the industry for just over 17 years now. I joke that the first 10 years, I probably couldn't even spell LTC. Like most people who are passionate in insurance, it came with a personal experience. Both my parents in their 60s required long-term care. Neither of them had a plan. Their advisor never had a conversation with them about insurance. So I also kid a little bit that they didn't have a plan, and they weren't even given the opportunity to say no to the insurance to fund the plan. But in all seriousness, I mean, it was a time in my life where I was trying to build a practice. I had we just had a new home, just got married and had our first child, lived 7 hours away from my parents. Mom had dementia for about 10 years. She was at home for about 10 years, or for about 5 years, in a in a memory care unit for about 3.5 years. And then they ended at a skilled nursing facility for about 2.5 years. During that process, my father was the primary caregiver. He was not wired to be so. Somebody who's in good health. I saw him emotionally and physically get torn down to actually him being the caregiver needed care himself. And he actually predeceased my mother, who had dementia. So that personal experience really just motivated me that there had to be a better way, right? There's an issue in the industry, and everything that I could found is really nobody wants to talk about it, right? Clients don't want to talk about it. Financial professionals don't want to proactively bring up the conversation, and I don't blame them, because a lot of times our clients don't want to have that conversation. But what I found is somebody has to be the leader. Somebody has to lead the planning conversation. And at that same time, through my father passing, still caring for my mother 7 hours away, it was the CLTC designation that really, the fire was lit, but going through the CLTC designation gave me the comfort and the confidence to have a planning conversation in a way that that felt comfortable to me. And a lot of the clients that I've talked to or advisors I've helped support, it's comfortable to them as well.
Well, as you bring up your presentation, Shane, I know one of the themes we have this month at E4 Insurance Services is when it comes to long-term care planning, hope is not a strategy. Can you talk a little bit about the strategy? And I know you're going to get into a case study here, but where do you begin in that process of helping develop that strategy?
Sure. So what I found to be the most successful is never leading with any type of insurance product. This is probably a good tip for life insurance, disability, but especially long-term care. So today I kind of want to go over a 3-step process. It says additional LTC sales. It really should say, more engaged and comfortable long-term care planning conversations with your clients. So really the 3 steps that we're going to go through is, how do we create a plan, right? A plan of care, or just create a plan for the client, right? The plan is going to be, where do you want to receive care? Who do you want to have physically provide it? And how are we going to pay for it? After that, step 2 is really going to be going over E4's proprietary long-term care analysis. This is an executive summary that allows us to really compare self-funding versus the various types of long-term care insurance. And then the last step is, just making sure that we're medically pre-screening our clients, that they can actually qualify for long-term care insurance. Before I jump into the whole presentation, though, really I want to set the stage, the mindset. Again, prior to my personal experience, if you would ask me what long-term care looks like, it's old age, it's nursing home. Most of the financial professionals I've worked with in the past, initially, we think of, hey, if my clients need care, we're just going to redirect that income in retirement to pay for that care. Now, that assumes that our client is likely in a nursing home. All of their retirement lifestyle expenses have completely dried up, and we have the ability to redeploy that income to pay for that care. The problem with that analogy is, how many people do we know that are retired, that are active, engaged, and healthy in retirement, and literally the next day they're flat on their back in a hospital bed, in a nursing home, unable to do anything. Their lifestyle expenses are dried up, and we can redeploy income to pay for that care. So long-term care insurance starts much, much sooner than that. It usually starts at home. Somebody needs help getting out of bed in the morning, someone to be there to safely make sure they can take a shower or bath without hurting themselves. Maybe they need assistance getting dressed before they start their day. These people still want to, go on vacations. They still want to go to movies, nice restaurants. They want to spoil grandkids. So this is where the math problem comes in, and it's usually bad math. If we haven't planned for it and we can't really account for it, when I look up here, when I've changed my mindset to start looking at long-term care, is simply a long-term care event simply creates a monthly cash flow issue in retirement.
I think, Shane, I've heard you describe it as, where would you find the money for a new $10,000 a month gym membership?
Gym membership, correct. So when we understand that it's a monthly cash flow issue, the care begins at home typically. We have all of our lifestyle expenses. They're static. That income is supporting our lifestyle. Very little of it's discretionary. And all of a sudden now we have a new $10,000 a month gym membership that we have to pay for, in addition to all of our other retirement lifestyle expenses. Where do we get that money? And that's really the mathematical equation that we have to solve for. And it's best solved, way before the event actually happens. So again, this is just setting the mindset. Once you start thinking of long-term care as simply a monthly cash flow issue. All of our retirement income is supporting our retirement lifestyle, and we now have a new $5,000 to $10,000 a month gym membership to pay for. How do we do it? So before we go into solving that answer, we got to identify who's an ideal client. Well, how do I go back, Danielle? There we go. Geez. All right, so identifying the ideal client. I usually look for clients that are in what I call the retirement red zone. These are clients that are typically 5 to 10 years from retirement. Up on the screen, it says they might typically be 50 to 65. But for any financial professionals out there, you're going to know these clients, right? That are 5 to 10 years from retirement. They're actually seeing the light at the end of the tunnel. They are taking your annual review meetings much more serious. They're much more engaged than they ever have before. We want to use that. We want to use their engagement, their motivation to now be involved in the planning process. All we have to do is simply add creating a long-term care plan to the pre-retirement checklist, and the conversation has to be had, and they're willing to have it.
And do you find in that retirement red zone that many of those clients also have parents that are much more either in some sort of assisted living, or they're starting to think about how their parents are going to process that care? How do you draw that
Sure.
experience in as well?
Well, I'm not going to spoil too much, because in 2 slides from here, I'm going to actually talk about the entry point into the conversation. So I'm going to side that just for a second, Dan, but that's a fantastic and great question, because I use that. And actually, that's information I usually want to know beforehand, because it helps me into the entry point into the conversation. So let's sidebar that for a second. I'm just going to bring this up. So once I have clients that are, 5 in the retirement red zone, 5 to 10 years from retirement, they're motivated, they're engaged. The next thing I do is I've identified the client. I'm going to put them in one of 3 segments. And the reason I do that is because there's different ways that I'm going to have conversations with them, and there's different ways that I can help them. So for example, Medicaid likely. I use that as a spousal couple, could be husband and wife, with $500,000 or less, right? I know in 2022, the healthy spouse can have about 138,000, the unhealthy roughly 2,000. It's going to be very difficult for that family to come up with an additional $5,000 to $10,000 a month, and they have a very short way to go to qualify for Medicaid. So these clients are Medicaid likely. Might not be a lot of planning I can do. However, what I can do is introduce them to an elder law attorney, let them get comfortable with what the process looks like for applying for Medicaid. Might give them some tips on if they're closing accounts, make sure you get letters from the bank or credit union indicating the account's been liquidated, it's a 0 value, things that are important when we go through the Medicaid process. Jumping to the other end of it is wealthy clients, right? Wealthy clients, and you can set this at any dollar amount that you want, but let's just say it's $3 million or more, right? And we'll assume they can come up with that additional $5,000 to $10,000 a month, right? Paying for that new gym membership without disrupting their family's lifestyle. My conversation is going to be completely different. Yes, you can come up with the additional money needed to mitigate that cash flow issue if you or your spouse needed a long-term care event. I start having conversations about, is that mathematically the best way to pay for care, right? Do we really want to pay full retail costs when we know wholesale costs is available? The other part with wealthy clients is I remind them that, at least based on my experience, wealthy clients don't liquidate their high-yielding investment assets. They don't liquidate their business, and they don't liquidate their real estate holdings to pay for care. They go to their lowest yielding, most liquid cash to pay for care first. Well, the cash is liquid, it's earning little to nothing. We have fantastic vehicles we could consider that give us leverage, tax efficiency, and predictability to pay for long-term care expenses. So again, conversation's different. And then there's the middle class, and it's a gigantic middle class where a lot of people fall in. I feel really or I'm really nervous for a lot of clients, husband and wife, couple with $1 million portfolio, right? It's going to be very difficult to come up with an additional $5,000 to $10,000 a month on top of all their other lifestyle expenses, retirement lifestyle expenses. And they have a long way to spend down before Medicaid will pay a penny, right? If we said the healthy spouse can have 138, unhealthy roughly 2, that's $860,000. That couple would have to spend down before their state will pay a penny under Medicaid. So just kind of a recap here again. I find the client who's motivated 5 years from retirement. I put them in 1 to 3 segments, gives me an idea of what we're going to have a conversation about. The next point is the entry point into the conversation. If you're a financial professional doing planning, you're likely having annual meetings scheduled with your client. And that annual meeting is a great place. So option 1, Dan, to your point, is personal experience. I'm always asking, hey, Dan, do you have any personal experience with long-term care? He's going to say yes or no. Usually if it's yes, I'm going to ask him to elaborate on it. I will say 9 out of 10 times I'll ask him if do you think it was a good experience or a bad experience? And I'd say about 9 out of 10 times it was a bad experience. But when I ask that question, tell me about it, and he tells me a bad experience, and I say, Dan, if you needed care, not saying you do, but if you did, how would you want your plan to be any different? And some of the things that I hear would be, I don't want to be in that nursing home that my father was in. I don't want my spouse to physically care for me like my mother did for my father. And I want to make sure that my family can maintain lifestyle. So within the first 5 minutes, they tell me their story. It's not a good story. We find out how they would want it different. And I just repeat it back to them. So Dan, if I heard you correctly, we want to make sure that we can build a plan for you that keeps you safe in the comfort of your own home. By doing that, we want to make sure that we protect your spouse and children physically by allowing them to supervise or manage your care, not have to roll up their sleeves and physically provide the care for you. And then the last part of the plan is we want to make sure that we protect all previous financial commitments that you set up for your family so they can maintain their lifestyle. All right, so that's a pretty common plan that we go through. It has nothing to do with insurance, whether you're wealthy, Medicaid likely, or middle class. Everybody needs a plan. Everybody's plans could be a little different. So the toughest part is if you don't have personal experience. I found especially type A personality male with no personal experience, never going to happen to me. The risk is 0. You really have to tie into longevity. So if you're a financial planner running income plans for your client, you're probably running them into anywhere from between 90 to 100. That is the best part, Dan. We're running your income plan to 95. There's an underlying belief that you could live to 95. Otherwise, we wouldn't be running that plan to 95. So really it's getting them to understand that, look, Dan, if you live into your late 80s, early 90s, it's reasonable to assume that just due to the frailty of aging, right, the loss of muscle mass, mobility, agility, balance, you might need care for a period of years, some standby assistance care for a period of years. We need to create a plan for you. And yes, you might think the risk is 0, but if that event does happen, there will be 100% consequences to your family, emotionally, physically, and financially. And even for the most type A personality male with a risk of 0, consequences of 100% to his family, the people he invited into his life, his circle, that's usually pretty powerful area to be in, and they're motivated to plan.
I know we work with an elder care planning attorney, and she has told me how many times she has heard, well, I'm never going into that nursing home. I'll take matters into my own hands, and I will never do that. And what she has found in her career, which is over a 40-year span, is that the nursing home is full of people who thought the very same thing.
Very same thing.
So how do you bring some reality to that conversation, Shane, as you go forward in that planning conversation?
Yeah, I mean, at the end of the day, the planning and the solutions aren't for that person individually,
It's the
right?
consequence that you're
It's the
focusing on.
consequences to the people they've brought into their life, right?
Okay.
Emotionally, physically, and financially.
Because their family members are going to bear 100% of the consequences. And that's really how you position that, is on the
Absolutely.
consequence side.
100%. Anybody who doesn't have a long-term care plan right now and hasn't considered insurance or secured insurance coverage, their plan, whether they know it or not, is they have 100% of their assets and income allocated to pay for care. And whether they know it or not, their spouse, their children, and maybe even their friends are physically, you know, on deck to provide care, right? My
Okay.
parents, I drove up to Bismarck, North Dakota for 14 months straight. I was up there 1 to 2 weeks each month, or each 1 to 2 weeks each month for 14 consecutive months. Stayed at numerous different people's houses and basements, worked from hospitals, from nursing homes. I can guarantee you my parents' plan was never to have me put my career and my family life and my social life on hold to drive up to North Dakota that often. But at the end of the day, I love my parents, and I, felt I needed to be in the position to help any way that I could. This is how most spouses, most children, even close friends are going to react.
So now we have Billy Anderson. What are we
Billy
going to learn
Anderson.
from Billy?
So this is going to be the case study. I'm going to kind of use a case study, and then I'm going to go over the steps, of creating a plan, talking about funding a plan, using our long-term care analysis to really walk the client through the options, and then medically pre-screening them. So yeah, this is my favorite. Billy Anderson. We do have an employee here named Bill Anderson. I assure everybody, these are two different individuals. Correct, Dan?
Yes. Yeah.
This is
We've changed the name to protect the innocent, as they
this
say.
is
Yeah.
Billy Anderson. Billy Anderson's a super cool 58-year-old. He's married. He has great health. Successful salesperson. Again, he's kind of in that retirement red zone, right? His runway is about 5 to 10 years before he wants to go into retirement. He's got 2 million plus in retirement assets, no debts, no liabilities. Again, from the surface, no debts, no liabilities, $2 million. Hey, can't he just self-pay if he wanted to? Right? He's got $2 million. Well, he understands that when he takes that 2 million of assets to retirement, it's now capital. That 2 million of capital is now going to generate income that's going to support his lifestyle. His lifestyle is going to have very little discretionary expenses. So in the event at his age 80, he has a new gym membership, call it a gym membership for $12,000 a month. How's he going to support his lifestyle and pay for this new $12,000 a month new expense? That's the issue.
Without invading all of his capital.
Correct.
Which
Because what happens,
income
I was
further.
just going to say, what happens when we invade capital? Well,
Right.
we have less capital that generates less income, doesn't support his lifestyle expenses. Something has to give. Now, what I'll tell you, based on Billy's projected what he wants to do in retirement, there's no way he's going to find $12,000 a month of discretionary expenses that he can get rid of and redirect to pay for this care. One area that might happen is if, yes, Billy is active, engaged, and healthy in retirement, and literally the next day he's in a nursing home, flat on his back, in a hospital bed, can't do anything, his expenses have dried up. Yeah, we could consider redirecting some of that income to pay for care, but it usually doesn't happen that way. So we got Billy. First thing we're going to want to do is it's not an insurance product conversation at all. It is a planning conversation. Billy, I want to create a plan of care for you, right? We talked about that plan of care. Where does he want to receive care? Who does he want to have physically provide the care? Who does he want to have coordinate the care? Finally, who or what's going to pay for the plan? So the plan I created for Billy is, Billy, let's create a plan for you that keeps you safe in the comfort of your own home. By doing that, we want to make sure the plan protects your spouse and children if you're emotionally and physically, right? But at the end of the day, let's just protect your family physically by allowing them to supervise or manage the care. Let's not have them roll up their sleeves and physically provide the care. And finally, let's create a plan that allows you to protect all previous financial commitments, which is going to allow Billy and his family to maintain their lifestyle. Right? Billy's, just because Billy needs help getting out of bed in the morning and someone to safely make sure he can take a shower or bath without hurting himself, his life's not over. He's still going to want to do things, but his spouse physically won't be able to help him with that. His children are elsewhere. How are we going to pay for the new expense to be able to take care of that? So once we have the plan, now we have to determine what's going to pay for the plan, right? So the first thing is we'll talk Medicare, right? Medicare is health insurance. Even if you get through all the red tape, the maximum Medicare will pay for is 100 days. That is short-term care. That's not long-term care.
Is that 100 days in your own home?
It is not.
Okay.
So
it's 100 days
you're
in
making
a
go through all the red
facility.
tape. So first of all, the red tape is you have to be in a hospital for 3 consecutive nights. You have to have a diagnosis. It can't be observation. They will then discharge you to a skilled nursing facility in which you need to be receiving daily rehabilitative care. So that's going to be either occupational, physical, or speech therapy every single day. Medicare will pay the first 20 days at 100%. Days 21 to 100, there's a daily deductible, which clients have to pay for. They'll pay anything over that. If you do have a Medicare supplement, it will usually pick that up. Again, I don't like to go in all these details. At the end of the day, it's health insurance. Maximum will pay is 100 days, even if you get through all the red tape. Again, 100 days, that's short-term care. It's not long-term care. And oh, by the way, care is received in a skilled nursing facility, not in your home. It doesn't fit the plan that we just created for you.
That's more end-of-life care, you would call
Correct.
that.
Yeah, that's a great way to look at it. So next one's Medicaid. Medicaid is a viable solution for clients that don't have any money. I like to look at it differently. So I'm going to go back to that couple that are both age 60 that have $1 million. Medicaid is an expensive solution for clients with money. So again, they have $1 million. The healthy spouse can keep 138. I'm rounding up for 2022. Unhealthy spouse, maybe
right.
2,000.
Every other asset other than the home and the car for that community spouse is eligible to be spent for care, unless
Correct.
they turn it into an ineligible asset, which
It's another type of planning. It is available.
It's crisis mode.
Crisis mode, 100%. But I mean, when you start thinking about this, if my wife has $1 million of assets in her name and I have nothing, and I'm the one who needs care, even though the money's in her name, we still have to, as a couple, we still have to spend down that $860,000 before the state of Minnesota here will pay a penny.
So that's an $860,000 expense for long-term care.
That's in a skilled nursing facility and not directed by where the care, it's not at home. Right. So it's a very expensive plan. That's my last part. Oh, by the way, care is received in a skilled nursing facility, not your home. The other part too, just going back, if me and my wife were on second marriages and we had a prenuptial agreement, and in the same situation, she has $1 million and I have nothing to my name. In the event I needed care and wanted to qualify for Medicaid, the state does not recognize a prenuptial agreement. They basically will say, combine them, spend down, or we're just not going to pay anything.
Okay, so what's the next one?
Next one, self-pay. So I don't care how much assets, I don't care if they have $5 million. Yes, they could probably pay for it, but something gives, right? It's capital. The capital's designed to generate income that supports lifestyle. The only way a client can truly self-pay is if they can come up with an additional, I put here $6,000 to $12,000 a month, in addition to all their other lifestyle expenses, so they can maintain their lifestyle. The last one is long-term care insurance, right? We're transferring money to an insurance company in some way, shape, or form. And really at the end of the day, it becomes the most viable solution for clients that can medically qualify for it. So really at the end of the day, we Medicare and Medicaid don't fit his plan, right? CARE's short-term, or he's got too much money. It's received in a skilled nurse facility, not his home. We don't even count those. Really at the end of the day, Billy has two choices. He can self-pay, keep all his money, accept all the risk, and accept 100% of the consequences to his family in the event it happens. If that event happens, or long-term care insurance. Again, he can transfer some of his money in some way, shape, or form, transfer some of the risk to an insurance company, and mitigate the consequences to his family.
So once we have that plan and we're looking at that self-pay option, I know that you've been a big proponent of one of our proprietary tools that really walks through an advisor having that conversation now for the next piece of it. Can you take us quickly through what that solution looks like?
Absolutely. So E4's proprietary long-term care analysis. Again, it's an executive summary comparing self-funding to the various types of insurance products, traditional LTC, hybrid LTC, life insurance with a long-term care chronic illness rider. I'm not going to spend too much on it, but I'm going to definitely give you an overview here. Okay, just a second. So what we have here is page one. Page one is really prepared for the advisor, their client. So in this case, prepared for your client, prepared by you, the financial professional.
So every one of these is customized to the client specifically.
Correct. Page two is a static form. Nothing will change here. But it really gives your clients at their own pace just some additional information. What is care? What are the activities of daily living? Common reasons people need it. What's the average age? Average age we got to look at is age 80 is the average claim. And the average claim is roughly about 3.3 years. So we'll remember that because we use that as part of this. But where do people receive care? Home health care, assisted living, nursing home. Again, going back to here, home health care. This is the default option.
Average claim dropped from 3.8 years to 3.3, and predominantly due to COVID claims, shortening the stay in a facility.
So really, we're getting now to the meat and potatoes on this analysis, right? So this is the state of Minnesota. Up here on the left, we have a 58-year-old. We're assuming the long-term care event happens at age 80. So that's 22 years from now. We know what the current cost in Minnesota is for home health care, assisted living, and nursing home. We're anticipating that those costs are going to grow at 3%. Again, the cost might be different, the inflation might be different, but we need a starting point. So we're looking at home health care today, 22 years from now, growing at 3% inflation. We're anticipating the cost of home health care being about $12,000 a month. If the average claim is, between that 3 and 4 years, as a planner, I'm going to plan for 4 years. So really at the end of the day, why this is important to me is it's not about insurance. It's about, hey, I'm 58 years old. I'm going to have a potential new cash flow issue 22 years from now while I'm in retirement. And it might be $12,000 a month in addition to all my other retirement expenses.
So there's your customized number. There's
Correct.
Your $12,000 a month gym membership is what you're really solving for here. And where are we going to take the money from?
Correct. And again, this can be customized. So we might say, you know what, I'm okay just softening the blow of that $12,000 expense. Right? I can come up with some additional stuff and still maintain my lifestyle for $6,000. Maybe I'm going to transfer, I'd like $6,000 from the insurance company. Some people might say, you know what, I'm really more concerned about nursing home, or I want to be in a nursing home, a real fancy one. I mean, you get all sorts of things, but here's a starting point for us into a conversation. So on this report here, there's a lot, but I'll try to simplify because once you understand it, it is pretty simple. The top row, the blue columns are going to be the self-funding. Right, that's just us taking our money, creating our own plan with managing assets. The orange column here, hybrid LTC, both on a 1-pay, a 10-pay. The green column is going to be a $600,000 life insurance policy, being able to access that $600,000 for a long-term care or chronic illness event, and the blue one's going to be traditional long-term care. On the left-hand side here, we're going to have the funding strategy. So how much money do we have to put in for how many years? What's the rate of return that we need to earn over the next 22 years to make sure that we hit our number of $12,000 a month for at least 48 months. Next column, if we never use it, right? Instead of 80, we just at age 85 life expectancy, we just pass away. What's left to our heirs, our funds available if needs change, how do we receive benefits, cash indemnity, reimbursement. So I'm just going to go through one as an example here. If we take $314,000 of Billy's money and we put it into a new account that's called Billy's LTC fund, and we manage it in a way that it's still liquid, we have as much predictability as we can, but we're really getting 3% net of taxes and fees each year for the next 22 years. Now, I'm sure we have some financial professionals on here that says, Shane, I can do better than 3. I can do 7. Well, if we plan that it's going to be 7, we have to plan that could be down 7, right? Being this is so important, it's going to fund his plan. We want it liquid. We need some predictability to it. But most importantly, as I said at the beginning, wealthy people rarely liquidate their high-yielding investment assets earning 7% to pay for care. Billy's going to go to his lowest yielding, most liquid cash to pay for care first. So if we assume part of the money's coming from low yielding liquid cash and part of it liquidating 7% investment asset, 3% net is a pretty comfortable place to be. So if he repositions $314,000, earns 3% net each year for the next 22 years, that'll give him the $12,000 a month for 48 months. If he never needs it and he's age 85 and passes away, almost $700,000 passes to his heirs. Here's one example, and I won't go through all of these, but the hybrid long-term care, instead of repositioning $314,000 of his assets, we could reposition $125,000, right? Significantly less. What we know about it is it's guaranteed based on the claims paying ability of an A+ rated insurance company. He will have $6,263 today, tax-free. At age 80, we know he has $12,000 tax-free.
And if he doesn't need care to 85, that 12,000 continues to grow. Correct.
Yep, it continues to grow. I don't know if I'd call this a downside or not, but at age 85, he never needs it. His heirs, he passes away at age 85, they get 150. That's a 67 basis point income tax-free rate of return. Could you have done better with that? Yes. But with insurance, again, the goal of insurance is to create leverage, tax efficiency, but most importantly, predictability. And we were able to do that for significantly cheaper. And if they
and you've mentioned the advisor on this call who says they can do better than 3%. If they're only putting 125 into this, they have basically another the difference between 125 and 314 to go to work with.
Correct. Well, and just right here, instead of 314, if Billy just repositioned 125 and put it into his own self-funding sinking fund, he would have to earn 6.7% income tax-free rate of return for the next 22 years. Is anybody, I can't see anybody's face, but I don't think anybody's willing to raise their hand that says, yes, I can get a net 6.7 each year for the next 22 years to pay for Billy's fund, long-term care plan. All right. So let me go back to here. Last part is just medically pre-screening. So we go through each of those. If I go back to, well, on the long-term care or the long-term care analysis, you have a lot of options. Reach out to your E4 RVP because we have a lot of just good coaching on it. We never have a client, pick out of these 6 options which one you like. We use the process of elimination. So which of these options do you really not like? Let's cross that off. It gives the client an easy win, and we're continuing to move in the right direction. But once we go through that, the clients understand that, hey, the insurance really, if I can medically qualify for it, it is the most viable solution to pay for my plan, to keep me at home, protect my spouse and children physically, maintain our lifestyle financially. but we got to make sure we can medically qualify for it. So one of the biggest things, if your client hasn't seen a doctor in the last, had an annual physical in the last 2 years, don't apply for long-term care insurance, or have them go get an annual physical. So we don't have basic information here. It's designed for 1 or 2 spouses. You can get that, send it to us. Our team will certainly go through and let you know if the client's, a quality individual that could qualify for long-term care. So summary, we created a plan of care for Billy. 2, we determined that really once you have your plan, there's only 2 ways to pay for it, either self-pay or insurance. We compared the 2. From there, if they like and want to go deeper on the insurance, we medically pre-screen them. So final thought, even if Billy doesn't want insurance, I personally believe that I've added value, right? I don't believe in selling insurance. I believe in giving clients the education they need and to at least consider how the insurance might enhance their plan. In this case, how it could fund their plan. So with that, I went long-winded, which I usually do in this conversation. But Dan, I'll pass it back to you if there's any questions.
Well, and like you said, Shane, your passion comes from a personal position of advisor never gave your parents the option to even consider that.
I said they didn't even give them the option to say no.
To say no. So it really comes from a place of wanting to make that difference. We can open it up here for any questions. I know we can go into much more detail, follow-up calls or meeting with your RVP. All of our regionals are very skilled in the long-term care analysis tool. Again, it can be customized for each of your clients and based on just consulting with you about really what is their plan. But do we have any questions? I'd like to ask a question, Shane. I know you authored and have helped put together a CLTC course, a 4-hour course. What is that called? And is that the best way for an advisor to learn more and really start to have better planning conversations?
Yes. Yeah, I could just say yes and leave it at that. No, CLTC is doing a great job of what I'll call, kind of finding your own path or choosing your own adventure, maybe is a good word. They had their CLTC masterclass, which I took in 2016. The CLTC masterclass is a 16-hour course.
Yep.
You have to pass a 100-question test. The 16-hour course, I want to say, is between $1,000 and $1,200. You got to pay for that, but the designation you get, again, I went through the whole thing. It is a very deep dive into the planning. It just gave me the comfort and, more importantly, the confidence on how to have this conversation the right way. Now, what we found is most, I'll say, financial advisors, for them to take 16 hours out of their day to get a designation they may or may not want to actually hold, it's been very difficult for them to get financial advisors to do that, right? Because they don't want the designation. They don't want to take the 16 hours out of their workflow, but they desperately, I believe, need this information. So what we've done is we've taken all of that course information. We've created a 4-hour course built by and for financial advisors in their language, how to integrate this process into their planning process in a comfortable way, creating the plan, educating clients on how they could fund the plan, using executive summaries, things of that nature. You do get a certificate. So you don't get the designation, but you get a certificate. I personally call it the litigation buffer that you can stick in your file. And, again, if clients or children's of your clients ever say, Mr. or Mrs. Financial Professional, what have you done to properly help my parents with this type of planning? At least you can bring that type of certificate out. But
is there a name for that course?
That is called the CLTC Foundations. So that is a 4-hour course. Again, I think it's maybe $399. You do get a certificate. which again, I call the litigation buffer. We're filing for CE right now through that. So that's going to be rolling out very shortly. We have, I think, a lot of broker dealers that are going to be interested in how they can help use that to help their clients, their advisors have better planning conversations with their clients. So,
well, for any advisor that's interested in that, please reach out to us. We'd be happy to get you enrolled in the next Foundations course. I know we have a couple of instructors on staff here that are part of that, affiliated with the CLTC program, and be a great way for you to do that. Well, hey, while we're waiting to see if there's any final questions, and we're still open if you have any, just jump in or unmute or shoot something in the chat. We'd like to remind you that today's brew and our full library of brewcasts are recorded and shared on our website under the brew blog. You'll see the red YouTube label, and you can go to www.e4.insurance, e4.insurance. Well, I don't see any other questions. I know there's some chats out there, some other information that Danielle has posted, but we have a giveaway today. And Shane, I need you to pick a number between 1 and 27.
Being it was just Halloween, I'm going to go with 13.
13. All right. Who's our winner? Lucky winner number 13, Bob Gaither is today's winner. Congratulations. Gothier. Okay. Is our winner. Congratulations, Bob. You'll be receiving a CE certificate from us and sponsored by Nationwide. Well, speaking of Nationwide, and continuing with our November theme of Long-Term Care Awareness Month, tune in next Wednesday as E4 Insurance Services welcomes Ben Hatch, Matt Riddick from Nationwide and Care Matters. And sneak peek, Care Matters is going through a price reduction, a price improvement, if you will. Next week, it's rolling out November 7. And so we will actually have Nationwide on talking about Care Matters, one of those solutions that were outlined in the analysis that Shane shared, and we're looking forward to that next week. Well, thanks. It's been a little longer masterclass brew today, but we look forward to seeing you next week on the brew. Thank you, everyone.